Hello, welcome everybody. This is to our CGAP webinar. This is our webinar on agent networks at the last mile. Delighted to have you. Let me just give you a little bit of housekeeping rules. Please note to all attendees that you can submit your questions at any moment during the webinar through the chat box that you have at the bottom right side of your webinar, of your WebEx screen. And make sure that when you type it, you send it to all attendees. There's a drop-down menu where it says to, and please select all attendees. We will be taking note of all of your questions, so please, no need to wait until the very end to submit your questions. You can submit them right away. Welcome, everybody. My name is Emilio Hernandez. I'm Senior Financial Sector Specialist here at CGAP, and today we will be discussing some of the key messages we've been coming up after about a 2-year global assessment of innovations around agent networks in rural areas, really focused at how can we reach the last mile. And we're accompanied by a distinguished guest of panelists that come from different parts of the world. We have with us Jojo Malolos. He's CEO of JG Digital Equity Ventures in the Philippines. He has a vast experience in the region establishing digital financial service providers. We have with us Ronald Webb. He's a payments professional, long track record in the payment system, mainly in East Africa, working with banks and mobile network operators. We also have with us Kartik Natarajan, who is Executive Director of Boombox in India. This is an e-commerce firm that has focused on rural areas and is partnering up with many financial service providers to increase the number of use cases that financial service can be applied to. So we will get started right away. I'd like to introduce this topic by reflecting on why are agent networks or distribution networks key to financial inclusion, because this is something that when we started 2 years ago, we found quite a bit of lack of clarity among providers, policymakers, and regulators on how important this was to promote digital financial services among the bottom of the pyramid. And what we've collected is global evidence that distribution networks are a key bridge for people who have never used digital financial services to start using them, because they need a bridge between the electronic or e-money world and cash, because providers of digital financial services are coming up with use cases that could digitize only part of their financial transactions. The other part remains in cash. And so if you create too many frictions between the two, it makes it very difficult for customers to use digital financial services. Agents are normally the most widespread means to allow for cash in, cash out solutions tied to digital financial services. And these agents play more than just, they're no more than just human ATMs. We've shown how they help build customer trust. They are able to communicate the advantages of different products in a trustworthy way, right? Which makes a big difference on use and uptake. And this is something that we see in the data. And there's a lot of causality studies that show that agent network coverage is actually causing higher use and uptake of digital financial services in developing countries. Now, as we looked at the world, the dominant and well-known established agent network models that banks and over the past 10 years mobile network operators have built have been very well studied and are very well documented. But in this recent review that we did, we also found new players coming into the agent network space, which really are related to e-commerce platforms or fast-moving consumer goods and retail merchant networks that have seen a comparative advantage in getting into the business of distributing digital financial services as part of many services that they offer. And what we see on these new players is that they tend to act as open platforms, which means that they're open to different financials and non-financial service providers. And these platforms, what they do is that they aggregate products and services that are of value to customers. We also see that this aggregation of services improves the viability of agents, because what it enables is for agents to generate more transactions per customer, since the customer can use more diverse set of services. And that helps in rural areas where population density is low. So an agent that naturally can capture fewer agents in rural areas can generate more transactions and be able to break even easily. So it's a favorable feature to have if you're going to establish rural agent networks. And just to say that regulation and policy has, in many parts of the world, has enabled these new players to be formal banking correspondents or banking agents, right? Examples include Mexico, China, and India. So they're definitely a new player, and in different degrees, they've been inserting themselves more formally in the financial industry. So all of our analysis, comes up with some implications for financial inclusion, mainly policy and regulation. We highlight that it's very important to recognize that what these models that different players such as bank, MNOs, and these e-commerce and retail merchant kind of networks are doing is that they're more and more linking financial services with real sector needs, either trade, ride-hailing, specific investments that customers want to do, and that can raise the value of your financial service. This service aggregation that I was mentioning, it seems very, very critical for agent economics. And one of the reasons why it has been so hard to establish agent networks in rural areas is because they don't generate enough transactions. So with this service aggregation and greater transactions per customer, these rural agents are able to improve their viability. So policymakers should balance the benefits of these new CICO agent models against consumer protection and market concentration risk, right? Because as these platforms, no matter whether they represent banks, MNOs, or e-commerce and retail firms, as they grow, these agents do much more than just cash in, cash out transactions. So consumer protection is something to watch out to ensure there's no mis-selling, there's no fraud, and there's compliance with AML and CFT kind of regulations. But there's also a lot of opportunities that you need to, for financial inclusion that you could exploit. And the very remote rural areas remain a challenge. Even the most successful models that we've seen around the world really cannot reach the super remote areas if there is no government intervention in terms of supporting innovation mechanisms or partially subsidizing the operation of agents so that they can operate in these areas, right? With that, the way we've structured the lessons from this work so far is to distinguish what are high-level principles that all the different agent network models that we've seen comply with, meaning this is constant across the very different agent network models. The more successful ones enable rural CICO agents to generate more revenue streams because of this service aggregation. That allows CICO agents to improve the viability in rural areas, which makes them more accessible to rural customers. Also, the definition of who can be an agent is being flexibilized. There's an expansion on the range of people who can serve as CICO agents. So not necessarily meaning that an agent has to be a physical, formal, registered business in a fixed location, but it could be a range of actors such as individuals in communities or, let's say, motorcycle or taxi drivers, for example. But as I was mentioning as well, the principle is that you also need to manage the risk and balance the risk opposed to rural agents without stopping innovation, meaning mitigating the risks on consumer protection and market concentration with the potential for much greater financial inclusion. As you start aggregating products, especially those models that aggregate financial and non-financial products, you're generating more data on the agent and on the customer. And this data can be harnessed to develop data-driven strategies to close the gender gap. This is a unique opportunity that we highlight with these newer models that are being successful in rural areas. And also, as hinted, there is a big opportunity to expand public and private partnerships to get these newer models further into the more remote rural areas, where partnerships that develop capacities in rural areas for people to uptake and take advantage of opportunities in the financial and the digital economy world seem to be very, very critical. So that's in a summary what I wanted to present as key messages coming up from our global analysis, but we'll go deeper to specific markets, and this is where we will bring the comments and the experience of our speakers into the discussion. Just a reminder, you can all start typing in your questions if you have any in the chat box in the bottom of your screen. So let me start motivating the discussion, talking to Kartik, who is CEO of Boombox, this e-commerce company focused on rural areas. Kartik, one of the things I like to highlight about your company and your model is that you are really an e-commerce provider, and you're not a financial service provider. But by focusing in rural areas, you've been partnering up with financial institutions so that you can use their agent networks to do payment transactions or credit services that are linked to your e-trade, right? And I wanted to ask you, what is the win-win pitch that you tell your financial institution partners in order to make this partnership work? What do they gain and what do you gain by partnering up and linking yourself into the financial sector industry?
Good evening, everyone. So we are a rural e-commerce company, and we primarily do business in rural India. And when we started our business, in fact, looked out for partnerships which has ability to influence consumers in rural markets and help us in transferring payments. So naturally, seeing the banking and financial services companies as opportunity for us to collaborate in rural markets, because one, the agents of banks have higher credibility with consumers in rural markets, and they also add the ability to transfer payments to us seamlessly. And because most of the agents in rural markets who work for banks and financial services, they do the transactions digitally because they're digitally enabled in the rural market, which is otherwise is a cash economy. So primarily we worked on two things. One is around the agent viability, because rural economy is a gig economy, and because they go through multiple seasons. In India, rural economy completely depends on agriculture, and as you are all aware that getting 12 months of consistent revenues from agriculture is extremely difficult. Therefore, people in rural India does multiple gigs. So, and most of the agents too who work as bank agents do multiple gigs throughout the year. You can also see farmers doing a bank agents most part of the year. So we thought of loading with more opportunities to do to earn revenue because a typical banking transaction or transaction heavy and margin light. We went with a proposition which is margin heavy and transaction light because because so many customers are being served by these agents in a given day, and they have very high chance of influencing customers because it's a very high touch model in rural markets. They collect cash and they do transaction digitally, right? They collect cash from the consumers, so that is cash in for them. So we wanted to give them other opportunities to use this heavy touch model. So we went with two set of proposition to any bank or financial services company. One, we help them to earn additional fee income through the agents. So it definitely helps them because it straight away adds to their bottom line without any additional spend or cost. They have to incur absolutely nothing. And when it comes to the agent, naturally with the same set of customers, without any additional effort, they earn more money from the same set of customers. So that's win-win for both the financial services company and for the agents. And most importantly, it helps the financial services company or the bank to retain their agents, which is extremely challenging and difficult in a market like India because, as I've said earlier, it's a multiple gig economy in rural India. So therefore, and there's heavy competition between the banks. You see agents, doing work for multiple banks and financial services companies, apart from the payment companies in India.
Right. You mentioned something that's very important and that comes out a lot in the topic of agent networks, and that these individual agents in rural areas, they struggle a lot with liquidity management. So normally, I would say, just to give an example, your financial institution who you partner up has an agent in a rural area, and these rural agents tend to have imbalances in terms of their cash available versus the e-float available that allows them to do digital financial transactions. And normally, we found that in rural areas, there's a tendency to be imbalanced. Agents have a tendency to be imbalanced of being too much cash out requests, which really puts them a burden in terms of their e-float availability. But the type of use cases that you bring in as an e-commerce firm are more cash-in requests because you are allowing people to pay, give cash to pay for the products and services that you trade, or to pay for a loan, reimburse a loan that they're making, and that helps the agent balance their liquidity in rural areas. Is that something that you've noticed in your case?
No, it's a fantastic point.
Kartik, you're breaking up. You're breaking up right now. Yeah. It seems that your connection is suffering, Kartik. We will get back to this point in a moment. So this is something that we I hope our attendees kind of appreciate that it is possible for e-commerce firms or other type of service providers to complement the use cases offered at the agent level. Moving along with case of going to Ron. Ron, in the case of the East African context, wanted to ask you, sorry, we're having a little bit of feedback with Kartik. We're resolving it. Ron,
you may want to mute it.
Yes, we're trying to, yeah. So, Ron, moving to a very different context, East Africa, right, where you've got some of the most well-known success stories in the digital finance world, such as M-Pesa, and you were actually leading M-Pesa for a while. Would you mind commenting your reflections in terms of what we've observed, for example, in Kenya, where the agent network with most rural presence belongs to the M-Pesa network? This is a network that traditionally, for a very long time, acted very much as a closed loop, but they seem to have been very successful at diversifying the service offer in a way that they generate those additional, let's say, transactions per client in rural areas, which has enabled them to be the lead, let's say, rural agent network in Kenya. Would you mind commenting about how this came to be, what are the pros and cons, and how you see the future of this market moving forward?
Yeah, sure. Thanks, Emilio, and hello, everyone. They've been enormously successful, and there are many reports and articles and research papers on the success of M-Pesa in East Africa. Big part of that success has been their universality and their ubiquity. And that means that people know they can use the service pretty much anywhere. You can transact in every corner of Kenya using M-Pesa, paying everything from street vendors to five-star hotels. And that is critical for the success of any payment service. In relation to cash in and cash out eco services in particular, they put a huge amount of effort into building out that agent network. And as we know, building agent networks is extremely expensive. And they have been very proprietorial about that agent network. And in fact, it was only when they were challenged that they permitted their agents to become agents for other networks. And so what's happened is you've now got the situation where many agents are multi-tenanted. They act as agencies for multiple financial institutions, both banks and MNOs. I'm still hearing Kartika in the background, but I'll carry on. The challenge with that for agents is they're now having to manage their liquidity across multiple silos, across multiple accounts. All of these services require the agent to have some kind of surety deposit held with the institution to protect the institution and the customer from any defaults of the agent, particularly when deposits happen. And this means that the agent has to split up money across multiple agencies that he is holding, which is pretty inefficient. And it has given rise in other geographies to very successful agent aggregation services that enable the agent to have a single pool of value, a single deposit, that can then be managed across multiple agency channels or agent service channels. And that's been really, really important. In East Africa, M-Pesa remains very, very defensive and proprietorial over their network, and it has been very, very difficult and extremely costly for anyone else to participate in that market. If you compare that with Nigeria, another market that I've just recently been looking at, which is still quite new, and in fact, licenses for true mobile money operations haven't yet been properly fulfilled. You've got an almost entirely card network that is completely interoperable. And there are multiple service providers growing out networks of cash in and cash out points that service everybody. And that means that a single agent can have a single relationship, a single point of management and cost that is much, much more efficient. And I think that interoperability is absolutely crucial for the success of these markets and for the success of agents, particularly in much lower income areas, more rural areas. Very, very important.
Right, Ron, and just building on that, I mean, part of the difficulty, let's say, if you look at the rest of the world is moving to this type of more open platforms, right? And where in some way or another, financial service providers are sharing more and more the same agent networks, which leads to this type of efficiency gains that we've been talking about of service aggregation that allows more transactions per customer. How do you see that evolving in a very different competitive context as East Africa? What do you think is going to make a change for companies like M-Pesa to finally decide we're going to share more agent networks?
Historically, with that environment, change has only really been affected through two mechanisms. One is regulation, and that certainly was the case in terms of interoperability between the MNOs in that market, as happened also in Tanzania. And the second is going to be social pressure. These organizations have responded to social media pressure, and that's been across all sorts of things. It's been across the kind of tariffs, it's been across fees, and it's been across how the service operates. And I think those are the two main causes for change. I mean, globally, we've all benefited from interoperability. Nobody considers when they go anywhere that their Visa or MasterCard won't work, because we all benefit from that type of interoperable platform. Similarly, you can move money on the SWIFT network and Ripple and many others in a completely interoperable way. Domestically, services like ZimSwitch, like BankServe in South Africa, just taking some of the ones, InterSwitch in Nigeria, have been providing full interoperability for card and point of sale services for a very, very long time. And yet we've had the MNOs holding out against that and trying to protect that walled garden service that they have. They have made moves, but they've made moves perhaps in a way that is similar to Apple. They'll do only what suits them. And that may be unfair, and somebody can challenge that, but that very much is the way that I view it.
Right. And one of the things that you highlighted that I would like to kind of emphasize is a very first step is interoperability at the banking system level between accounts. And then something very different is agent interoperability. And what we're finding is that you really need to build on banking level interoperability at account that trickles down to many opportunities of different forms of, let's say, agent network sharing. And this is perhaps a nice segue to Jojo, who represents an agent network manager company that, started, if I understand, if you talk about the case of Wing, Jojo, which you led for some time, you started with only airtime top-ups, and then you created this digital platform that enabled airtime top-up among your agents, and then you started partnering up with many different kinds of service providers to aggregate these services and generate more transactions at your agent level, taking advantage of this interbank agent interoperability, right? So I wanted to ask you, Jojo, maybe describe a little bit, the type of financial and non-financial service partners that Wing partners up with, and kind of the logic of the model, and maybe comment a little bit about your scale. How do you see rural markets, and how do you select the products that you would like to distribute? How do you ensure they have value for your customers? Jojo, can you hear us? I see your audio is connected and you're not muted.
Really, Ron here. I'm not hearing anything either.
Okay. Kartik, maybe you can you hear us?
Hello, can you hear me?
Oh, Jojo, now we can hear you.
Okay, okay. So thank you again. Good evening to everybody. Yeah, I think the agency banking proposition or agency banking experience in Cambodia is something very unique, and it's worth sharing so that everybody can learn from the uniqueness and how we've been able to scale it. So, as mentioned by Emilio earlier, it started as an agnostic agent network for airtime purchase, where we are not connected to any telco, and we basically came up with a system where people can buy airtime, top up their airtime via a.
Jojo, are you still there? We seem to be having network issues today. Um, what just to highlight a little bit and comment on what Jojo just mentioned. So the idea here is that one thing that we find very striking about the wing model and this type of agent network manager companies is that they're able to create this single digital platform where many service providers can deliver their services, and they recruit and onboard a lot of agents around the nation uh, to distribute these services. But what this does in a way are two important things I would like to highlight. They create a single e-float that can be used for all of those services between different service providers. That also helps liquidity management for the agent. Going back to the East African model, we can, in our field visits, we can see agents that have 3 or 4 POS devices from different providers, each one where they e-float, and they can't, move liquidity around these accounts versus through an agent network manager, they're able to have a single account and they're able to use their liquidity in a more efficient manner, which helps a lot in rural areas, as I mentioned, where liquidity management is particularly difficult. The other thing is creating that value for customers. We've noticed, like Jojo was sharing us, that they've been able to select very carefully the type of services that they offer to rural customers in a way that it brings value to customers, because you can aggregate a lot of services, but if these services are not really in tune with the type of demand that rural customers want, you won't see that increase in transactions. And just one example that Jojo shared with us earlier was a health insurance product, microinsurance product, that was a policy premium that cost $1 a month, with very specific coverage, and is one of the most successful products in rural areas. And it's not picked up in urban areas where you tend to have more formal employees who have medical insurance through their employer, right? So this is just to highlight some of the advantages of this model, but just to highlight that across the 3 models that we've discussed, you can see that there are certain principles that hold, and especially this service aggregation, or this aggregation of valued services, that makes a big difference. Now, even in the more closed environment like the MNO world, where agent exclusivity and account interoperability have been hard to promote, given the legacy of the leaders in this industry, which come from the telecom world, some of them have been very successful at diversifying the service offer so that they allow their agent networks to be viable in more rural areas. I wanted to go back to you, Ron, about this. One of the things that we've noticed is that the few very successful MNO networks that have reached rural areas, in a way, they're few. I mean, I could just give an example of M-Pesa, but also Econet Wireless. However, would you say that's the norm? We find that they're rather the exception, right? Most MNO provider models have not been as successful reaching scale beyond the urban strongholds. Is that your impression as well, Ronald?
Yeah, I think that it's partly true, and I think there are a number of reasons for that. Partly it's execution. In many cases we've looked at its environmental and competitive pressures. If you take, let's say, for example, in South Africa, the banking system there has been so strong, there really hasn't been a huge opportunity for MNOs or fintechs or other service providers to make any significant impact. Smaller ones have in limited geographic regions and have provided quite rich services in a sort of a locale. But in terms of broad rural penetration across an entire country, no, that really hasn't happened. And I think perhaps this is a bit of a two-edged sword. The success means that it has been very difficult for competition. And the early success, for different reasons, Safaricom successful through excellent execution and focus, EcoCash successful because of the complete collapse of the traditional cash market. There's just no liquidity cash available, and it's a bit of a Hobson's choice for customers. They're using the only thing they can to make purchases. If I look at CICO services particularly, I look at cash in and cash out services and call them, payment system or financial system adolescence. What happens, and we're starting to see this happen in East Africa, is people who don't really trust the network will cash in, transfer, and immediately you'll see cash out at the other end. The beneficiary will immediately cash out. And there's two reasons for that. One is trust. If I've got cash in my hand, I know it's trusted, understand it. The second reason is, well, I've got no other way of using it. If I want to transact beyond receiving the funds, the only way I can really do that is in cash. But as a network grows out to ubiquity, to universality, like M-Pesa, and to a slightly lesser degree EcoCash have achieved, it means that I can then move on to other transaction types. I can actually purchase my goods using those services. But only if the price point is right. And this is a big restriction. If we take Zimbabwe as one example, people don't have a choice. And they pay a huge amount. In fact, they pay quite a bit more than they pay in real terms in East Africa for these transactions. And it'll be interesting to see, once cash liquidity does return to that market, how the transaction volumes across the digital service providers will reduce. Certainly in a previous cycle of this problem that has occurred in Zim, we saw card transactions across ZimSwitch spike up dramatically when cash became short. Once locally printed money was available again in that round, the transactions fell back pretty much to the pre-levels prior to cash shortages. So where universality, trust, pricing have been resolved, that becomes a much easier runway effectively for the growth out to the furthest reaches of an economy to get there. It certainly has made it hard for competitors. I mean, one of the other MNOs in Kenya has recently spent an enormous amount of money replatforming and have only managed to get a very small number of users, not viable in any way at all. And so interoperability at all sorts of levels is required to ensure that there is sufficient competition to keep fees appropriate.
Thank you, Ron. I think we have Jojo back. Jojo, can you hear us?
Yes, I can hear you. Can you hear me?
Yes. Thank you. Ron just concluded a comment. Jojo, perhaps we can go back to you. You wanted to give us a little bit of insights in terms of how much, for example, Wing has grown. How much is it in your operations in rural areas, and how do the rural market fit into your overall growth strategy, at least in Wing Cambodia? If you could tell us a little bit of that.
Yeah. Yes. So sorry about earlier. Yes, we have about 7,500 agents across Cambodia, 16 million people. Last year, we processed about 130 million transactions, so that's about approximately 40 transactions a day per agent. And 21% of the population is urban, and about 79% is rural. So you can imagine that we have covered the country 100%, and much of the transactions that are happening are across rural areas. So there are three basic criteria by which we operate an agency network. And as mentioned earlier, we really bombard our agents with a lot of transactions, and whether that's financial or non-financial, because the main objective, the first criteria, is that they have to be incentivized. They have to be really making money so that they will be able to continuously operate an agent. And we became the hub of all of the, a lot of transactions in Cambodia. And we target areas that had a lot of commerce, right? Whether the commerce is about somebody selling fish or somebody selling vegetables in a wet market or dry market, somebody selling phones via, all of these phone networks, phone shops, or mom and pop shops. So we basically get all of our agents to become SMEs. So they invest some money, and this is the part of the value chain that we create, wherein there are some agents who are not able to put up money to manage liquidity, and we vouch for them so that microfinance companies will be able to lend them money.
Some reason we lost Jojo again. Good. So anyway, I think he was getting at the rural presence that he has, which is quite vast, and that rural markets have become an integral growth strategy for Wing in Cambodia, given the size of the rural population in Cambodia. Cambodia is a relatively rural country. So developing those partnerships with products that are of value was critical for them. So we're just right on time to perhaps do some of the final comments from each one of you. In terms of, I wanted to give you a question that relates to the future and how you see things evolving in your respective markets, which are very, very different. Perhaps comment on your opinion about the future of digital financial services. I think everyone in this business and this industry believes that ideally cash in, cash out is an intermediate step towards, let's say, a fully digital financial industry, right, where cash is no longer needed. And I just wanted to share a bit of the data that we've collected globally from payments data with BIS and merging it with in-country studies. We see that few countries in the world have seen their cash in, cash out infrastructure decrease. Very, very few countries. The only ones that we see data for is China, Sweden, and Norway. If you see more developed financial markets like most of the European Union and the United States, cash in, cash out infrastructure remains constant. It plateaus. It doesn't grow, but it doesn't decrease. That includes the UK. But in the developing world, cash in, cash out infrastructure is increasing sharply along with digital financial transactions. There's that correlation. So I just wonder, if we hypothesize that is the journey that most countries go through, where you see a very sharp increase in cash out infrastructure, it plateaus and eventually it decreases. When do you see that happening in your respective markets? Do you see that is it close? How confident are you that we can stop depending on cash in, cash out networks? Maybe we start with you, Ron, since you seem to have the best connection.
Yeah, Emilio, if I can comment on the UK market quickly, I've been doing a bit of work here recently. And in fact, the number of access points for cash out is decreasing here in the UK. In fact, to such an extent that organizations like Age UK and others are looking at this. And in fact, the government here has created a working group focusing on ensuring the continued access to cash, because the elimination of cash access impacts the poorest the most. And in fact, research that's been done shows that folk earning £10,000 and less make the most use of money, followed up by folk that are 65 and older. And that's more of a habitual and a comfort use for cash. Despite the massive increase of electronic transactions here, and billions of pounds have been spent, and we're somewhere between 55 and 70% of all transactions by volume now being done digitally in the UK. 97% of folk here still carry an average of £40 around with them in their wallet. And I think that's just a safety thing, and there are certain transaction types that they continue to do. The ATM network has been reducing for some years. The access to free cash withdrawals has also been reducing as bank branches have been eliminated. These are costly services for the banks to operate. And as they focus more and more on digital channels, so access to cash has diminished. It's done so on the back of the success of digital payments. And this is the fruition of Ignacio Maz's DUMU terminology that he uses, where any digital financial service has got to focus on, firstly, daily relevance. If you really want to be successful, you've got to provide services that are relevant to customers daily. Doing domestic remittances or international remittances happen periodically, but purchasing things, for example, happens every single day. So that's the first critical thing. The second is universality, ubiquity of access. That is a key thing. And then also offering multiple services, which is how you opened here in India, offering e-commerce, insurance, and other products and services via these channels is another critical thing. And those all then result in the uncaching of our network, moving to digital payments. The difficulty for many poor folk is cash is frictionless. When I transacting cash, there's no third party taking a slice of the action. Yes, it costs money, but it doesn't cost the two transacting parties the money. It costs the central bank, it costs the commercial banks the money to move that cash around. Digital services take that cost and put it back to the transacting parties. And it's still somewhat of an inhibitor, particularly for poorer folk. So what do I see happening? I see the increase of digital payments, allowing folk to do stuff, what they need to do every day digitally. And that will continue to grow. And we'll see a slight reduction of cash use over time. It is not going to be fast, in my opinion, in emerging markets because of the inhibition of fees. Right.
So, nutshell, even when you start seeing a decrease in cash in, cash out, you need to be very careful about those people falling through the cracks, suffering from the digital divide.
Correct.
But still, in developing countries, it's going to be a while since we get rid of the need for cash in, cash out networks. Jojo, would you like to comment in terms of your opinion on how, how much dependence on the cash in, cash out network in your market do you see in the future? Do you see it decreasing, or is it still going to be very important over time?
Hello, yeah. Can you hear me?
Yes, we can hear you.
Yes, I think it's going to stay for a longer time, especially for the unbanked, for the base of the pyramid. I think people at the base of the pyramid will still hang on to their cash. The only thing that's different, I think, is that they have an access to agents, and if the agent is 20 meters or 50 meters away from them, they would rather go to the agent and put their cash there to facilitate digital transactions. So, that's quite evident in Cambodia. That's quite evident in Bangladesh. So I think it's going to stay for a while, and I think that's going to be.
Oh no! For some reason, we're struggling with Jojo. I'm so sorry, folks. Sorry, Jojo. Kartik, can you hear us? Maybe you have last words. I don't know if you were able to resolve your connection issues. Kartik, are you there? Sorry, that's the problem of organizing a webinar from with folks from literally all over the world. Oh, Kartik, yes, we can hear you. Kartik? No. Sorry, my mistake. So, sorry, Kartik, we are hearing you very patchy. We're going to lead to question and answers. We've been receiving, thank you very much for all of these insights, colleagues. I found it a very fascinating short trip around the world, right? Looking at very different markets and different strategies that providers are using successfully, I would say, in improving their reach in rural areas in very different manners. Going to some of the questions, opening up for questions, our colleague Peter Knack asks about the Alibaba partnerships with the government in terms of enabling rural reach. I would say that maybe that's more a question for me. We did go to China. We've been studying the Chinese model in detail, and I would say similar to other markets like Indonesia, there's this tendency that government has been a critical enabler of establishing financial services in rural areas, very much through state-owned banks and the networks of agents and branches of state-owned banks, which have enabled great access. But there's a complementary there that we've noticed, especially very mature in China, where this type of new players, e-commerce firms that come with a lot more use cases, bring a lot more value to those financial accounts that have remained very dormant, which have been provided by state-owned banks. And further than that, the government has been in China has been very proactive in developing training programs for rural villages where they train rural entrepreneurs on the options and the possibilities of exploiting the employment opportunities or business opportunities of the digital economy, which is a tremendous help for companies like WeChat and Alibaba that try to set service points in rural areas because they find qualified people and they don't have to invest so much in training them on how to use their digital interfaces. I hope that answers your question. There's certainly a big involvement or role for the government to promote this access, and there's complementarity between, let's say, the state interventions and private sector interventions to generate value. There's another question related to what are the enablers to bring service providers to implement the sharing of their agent networks. I think that's a question that depends on the market you're in, and just to bring out some of the points we've already discussed, it's a very difficult competitive and market setup in East Africa, where you got so much legacy issues around competitive strategies between the lead providers that keep the agent networks closed, right, and interoperability quite limited. But that, as you deal with the necessity to bring value services to customers, you know the tendency, even in those markets, is to have these providers partner up with agent networks. And like Ron was mentioning, in some countries where the market is very, very stringent in opening up, there is a role for regulation to come in and step in and push that to happen faster. But that's not necessarily the case that you would take in other markets where private sector is very keen to create these partnerships, and it's more a matter of allowing these partnerships to happen, right? It's not, you don't need to push providers to seek interoperability. It's more creating the policy and the regulatory framework that make those partnerships, formal and viable and legal, right? So that your partners can come together. So there's always a role to play for regulation, but regulators, I think, need to be very sensitive to the conditions of their markets to give the right carrots and sticks. And it's not always about imposing interoperability. It's sometimes a lot more about encouraging this new type of partnerships and innovations that bring value to customer in terms of more diverse and valued services. There's another question about is it better to let market leaders invest in expanding its network or force them to accept interoperability? I think it relates to the previous question where you need to be very, very careful as a regulator to not to impose too quickly. You need to be very in tune on what are the frictions between your lead providers and be very sensitive to their conditions. I would argue that in a country like Kenya, if the regulator has done a pretty good job at knowing when to come up with a restriction, and they have recently, not over about 2 years ago, demanded that agent networks should not be exclusive, and they worked a lot on interbanking interoperability, which is a critical building block for agent network interoperability. Colleagues, let me check if there's more questions that I may have missed. I think we've covered it, and actually we're just about run out of time. Just 1 minute to thank you all for your participation and your questions. And very special thanks to our panelists, Ron Webb, Kartik Natarajan, and Jojo Malolos. Thank you so much for joining and sharing your experience. I apologize to everyone for some of the network connection issues that we've had, but I hope the main messages have been interesting and useful for all of you. Thank you, Ron. Thank you, Kartik. Thank you, Jojo. And thank you to all attendees.
Thank you.
Thank you very much. Thank you, everyone.
Thank you. Just to let everyone know that the presentation, it will be available on CGAP events page, and also the recording of this webinar will be available. Thank you, everyone, and have a great day. Bye-bye.
Bye-bye.